Let's now further develop this idea of objectivity versus subjectivity. Remember what we said. Objective is fact-based. Are you being objective in your trade, or are you being subjective in your trade? What we're going to do now is we're going to go through a couple of examples. And I see this all the time. That's why I've put these specific examples. What I want you to do as we go through each example is I want you to put your idea. Before I answer it for you, I want you to tell me whether it's being objective or subjective. And hopefully by the end of the slide, you'll get a better understanding as to why it's so important to remain first and foremost objective with a little bit of subjectivity. So, our first example. All right, the US labor data non-farm payrolls. It's the most highly anticipated data piece out of the US that comes out on the first Friday of every single month. Now, here's the example. So on any Friday, choosing Friday, the non-farm payrolls rises 320,000, but it was only expected to rise 180,000. So straight away, there's a huge piece of information in the market and prices need to reprice. So, first and foremost, is this objective or subjective? The US dollar should rally 1 to 2% given how strong the data is. Okay? Yes, it's subjective. Why? We don't know how far the US dollar should rally. Nobody knows how far the US dollar should rally. Alright? It could go up, it could go down. Nobody knows. To say that it should go 1 to 2%, given how strong the data is very subjective. It's very opinionated. Our next example. The US dollar could initially see buyers enter given stronger than expected data. Now this is a far more objective statement. Why? Because as we can see, the US dollar should see buyers. In other words, we are basing our statement on fact. In other words, we know if we get a much stronger US non-farm payrolls, factually we should see buyers. Okay? We might not, but factually we should see. That means we are remaining objective. Then our third example. The US dollar could see buyers enter with a high probability for a trend-like move. However, if buyers are unable to sustain a strong bid, this implies strong sellers are using liquidity to execute large orders. Now this is a mix. It's a tricky one. It's a bit of objectivity with a bit of subjectivity. But note how we're being objective first and foremost with a little bit of subjectivity. So what we're saying is the dollar could see buyers enter with a high probability for a trend-like move. That's our objective statement. Our subjective statement is that if the buyers cannot sustain a bid, it means that sellers are utilizing the liquidity to execute large orders. Now this bit of subjectivity comes from experience in trading the markets over non-farm payrolls. Important to note, guys, we are first and foremost always objective and then a little bit of subjective. It's important to have a mix of both, but always rely on objectivity to make your trading decisions. Why? Because it will protect you in the long run, whereas your opinion will only cause you damage. Now, our second example. As you can see, the E-mini S&P 500 has gapped lower because of an aggressive overnight sell-off after the unexpected Brexit decision. So a lot of you would have seen this example. A lot of you would have come the next day and said, well, the UK's left, it was never expected, this is the worst thing that's ever happened. All we got to do all day is sell, 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 sell. A lot of you would have been dragged into a subjective idea there. Why? Well, because CNBC, Bloomberg, Financial Times, Wall Street Journal, all of these publications were telling us that is what should happen. Therefore, straight away, we all put our sell-side hats on for the equity markets. And we said, well, our opinion is the same as the media, therefore it must be right. Was that the case? Let's have a look. So, our first statement, the market can bounce because it's oversold. Can it bounce? Should it bounce? Okay, the market can do anything, guys. Right? Is that an objective or a subjective statement? It's very much subjective. It's opinionated. The market can bounce because it's oversold. How do you know what's oversold? Okay, these are the kind of questions you want to be asking yourself. Then, the next example. There is a high probability for a gap and continuation. Okay? Again, Now, with experience and our strategy, we know that because the markets have gapped, we know that there's a high probability for continuation. So the fact that we're stating a fact-based statement means we are being objective. All right, we've seen the gap, the market has showed us the gap, and we are therefore remaining objective with the information that we receive from the market. Our last example, if the market trades to my key support, I will buy it for a bounce. Okay, here again, we've got a little bit of a mix. We've got an objective statement as well as a subjective statement. Why? Because if the market trades to my key support, all right, what is key support? It's subjective, right? One man's key support is another man's key resistance. Don't forget that. So the fact that we're saying if it trades to my level means we are being subjective. However, because we are trading it or I'm buying it for a bounce, I'm employing an exact strategy, I'm remaining objective. By allowing myself a specific strategy with a subjective opinion, I can have an objective outcome, if that makes sense. Okay, so just ensure there's nothing wrong with having a subjective opinion or an idea about what should occur. Just make sure you've got an objective strategy in place to keep the balance. Then our next example. WTI oil has sold off on oversupply fundamentals, but Goldman Sachs thinks there is a possible correction likely. Okay, so if I see a buying tail on the 60-minute candlestick, I will buy with Goldman's comment. Is this being objective or subjective? Well, note here, okay, we said if I see a buying tail on the 60-minute candle, I'll buy with Goldman's comment. I'm not buying because of Goldman's comment. I'm buying because of a buying tail. In other words, I'm allowing the market to show me an objective outcome before I execute a subjective idea. I'm being objective. Then, our next example. If I see a low volume extension of the current day's low, I'm going to fade it with a $1 stop given how important Goldman Sachs' opinion is. Again, it's a trick. Of course, we're leaning on Goldman Sachs' comment. However, we are utilizing an objective trading strategy to execute on. And because of that, we are remaining objective, even though we are using somewhat a subjective statement from Goldman Sachs. Then our last example. I will get long and look to average myself into the position, given I agree it is definitely oversold after moving 15% in 3 days. Okay? Again, this is clearly subjective. Why? What is oversold? Okay? Yes, some people use overbought and oversold tools. But those tools are based on so many different varying parameters. One man's oversold might be one man's opportunity to continue to sell. Don't forget that. Lagging information isn't necessarily objective information. Forward-looking information, however, is objective information. And it's with volume profiling that we can ensure all the information we have at our disposal is forward-looking as opposed to lagging. Those are some of the examples from subjective versus objective information that we receive from the marketplace.